We're looking here at question 32 in the March-June 17 paper, and we've done part A. We're now going to look at part B. Part B, calculate the expected NPV. So we're going to do the net present value and comment on the financial acceptability and on the risk relating to variable costs. So there's going to be a little bit of a complicating factor in here. There's 9 marks, so let's see what information we've got. So we've got a planned investment costing 20 million, and it's going to be 4 years, and it's going to have a terminal value of 0, so no scrap value. We're given information on the sales volume, the selling price, and the fixed cost. Selling price, we need to adjust for inflation, 3.5%, so we'll need to do that. Fixed costs are in nominal terms, so that means we're just using the figures. They've already been adjusted for inflation. Variable cost depends on whether competition is maintained, so they've given us probabilities here for variable cost and what the variable cost will be. Now that means we are going to need to do expected values for that, because we need to use one of those numbers. We can't choose which, and we'll have to use expected values. And then also there's going to be variable cost inflation of 4%. So a little bit of a complication there that we'll have to deal with. We have tax allowable depreciation, reducing balance, corporation tax, 25-year, 1 year in arrears, and we have nominal after tax weighted average cost of 10%, cost of equity 11%. So look, we'll generally speaking go for the weighted average cost of capital here that's after tax. So that's the one that we're going to choose. So look, we understand what's required. We do the same process as always. So for our NPV, our process is always step by step. Number 1, do our inflation calculations. Now, we'll have to do the expected value in between that for the variable cost. Number 2, we'll deal with our written down allowances. And then number 3, well, we would do working capital. There's no working capital in this, so that'll mean we're able to do the NPV. So that's the order we're going to do this in. We want to start with the inflation because we can pick up marks really easily, and we'll start with the sales. So we've got selling price, sales volume, and it's going to inflate by 3.5% per year. So that's going to be relatively straightforward. Let's do that first. So we did part A, we're now moving on to part B. And we'll do inflation first. And we'll start with sales. And we've got 4 years worth. So 1, 2, 3, and 4. And the sales price that we are given in the question is 26.5, 28.5, 30, and 26. So 26.5, 28.5, 30, and 26. And the inflation we said was going to be at 3.5%. So that's going to be times 1.035, 1.035 to the power of 2, 0.035 to the power of 3, and 1.035 to the power of 4. Okay, so when we multiply that out, we've got an inflated price of 27.43, 30.53, 33.26, and lastly then 29.84. Now we need the volume. So I'm going to drop the thousands on this, and we'll use our sales volume from the first line: 440, 550, 720 and 400. So those are the ones I'm going to put in. So we've got 440, we've got 550, 720 and 400. Okay, so the key figures, once we've multiplied the volume by the inflated sale price, we've got 12,069, we've got 16,791, 23,947 and 11,936. Okay, so those are going to be the inflated sales price. Okay, the next bit that we need to do is to inflate the variable cost. But remember, we've got an expected value calculation to do here, because it's not just clear cut what the variable cost is going to be. It's going to depend. So for the variable cost, we need to start with the expected value. So there's three costs given to us. We're then given the probability, and we'll multiply that out and add it up to get the expected value. So the costs were 1080, 12 and 14.7, and the probability 0.45, 0.35 and 0.2. So given to us in the question. So that's these figures down here, the probability and the variable cost. So when we multiply that out, the expected values 4.86, 4.2 and 2.94, and then we add it up, which gives us a nice round figure of 12. So I know it's a bit of an estimation, it's not going to be exact, but the expected value is probably going to be the best approximation that we can get. We can then do our inflation on the 12. So the inflation for the variable costs is going to be year 1, 2, 3 and 4. We know that the cost is going to be 12. And the inflation was expected to be 4%. So inflation 4%, 1.04, 1.04 to the power of 2, 1.04 to the power of 3, 1.04 to the power of 4. Okay, so that gives us an inflated sales price of 12.48, 12.98, 13.50, and lastly 14.04. The volume is the same as the ones we used for the sales. So 440, 550, 720 and 400. And when we multiply that out, that will give us the inflated variable cost. So 12.48 times 440 is going to be 5491, 7139, 9720, and lastly 5616. Okay, so those are going to be the inflated variable cost figures. The fixed cost, remember, we said was in nominal terms, so we'll just use these figures for the fixed cost in our NPV. So that takes us down to the tax allowable depreciation. So we'll need to deal with that. 25% reducing balance on the 20 million. Corporation tax of 28% in 1 year in arrears, and a terminal value of 0. Remember, we were told up at the top. So bringing that into our written down allowance working. So this will be working 2. Written down allowances. Same one as we do all the time. Year, the balance, the written down allowance for the year, the tax saving. And then just be careful with the year that you get it. And the amounts we're using here is 25% for the written down allowances, 28% for the tax savings. So just write those in to remind yourself as you go. So year 1, balance 20 million. Written down allowance, 25% of that is going to be 5,000. Which at 28% tax is going to be 1,400. So that's the figure that's going to go into the NPV, the red one, and it's going to go in year 2 because it's paid 1 year in arrears, and this is the benefit, 1 year in arrears. Year 2, that leaves us with a balance of 15 million at 25%, 3,750, giving us a tax saving at 28% of 1,050. That's going to come in year 3. Year 3, then we have 11,250. At 25%, then 2,813. 28% of that is 788. And that's going to come in year 4. In year 4, then, the remaining balance is going to be 8,437. I always put an extra line in for scrap. In this case, it's 0, but that reminds you to do it. And so you're going to get the full benefit of the 8,437 at 28%, which is going to give you 2,362. And that is going to give you that benefit in year 5. So no difference to lots of other ones we've seen. You've just got to be careful with the percentages, and you've got to be careful with the tax and the scrap value. Okay, I think that is everything ready to go. We can now fill it into our NPV calculation. So probably not enough room there, so we'll start a new page here and we'll say, okay, NPV. We're going to have a time period 0 for our initial investment, then a 1, 2, 3, 4 and a 5 because we need an extra year for tax at the end. And I'm going to start with the sales from working 1. And the sales figures that we used were 12,069, 16,791, then 23,947, and then 11,936. The variable costs, again, we did that in our inflation working 1, were 5,491. Then 7,139. Then 9,720. And 5,616. Lastly, fixed costs. We are just going to take them directly, as we said, from here, because they're given in nominal terms, means they're already inflated. We just need to write them in. So fixed costs 1100. then 1121, then 1155, and lastly 1200. Okay, so that enables us to get our taxable profit. And the taxable profit at that point is 5478 for year one. Then year two, 8531. Year three, 13072. And then 5120. The tax is at 28%. So 28%, and don't forget it's payable the year after. So 28% of 5478 is going to be 1534. Then again for the following year, 28%, 2389. And so on, gives us 3660. And lastly, 1434. And that's paid in year 5 because it's paid 1 year in arrears. Don't forget though, we had some tax benefits from our written down allowance. So the benefits in working 2, we're going to add back, and they were 1400, 1050, 788, and then lastly 2362. Okay, and when we do all of that, the after-tax cash flow is going to be 54878. $8397, 11733, 2248, and lastly then 928. Don't forget our capital. So it was 20 million, no scrap value, so we didn't have to deal with anything else. And what do we need to do now? We need to discount it at the discount rate that's appropriate, which we said was 10%. That will always be 1 here, but then we need to check the 10% rates in our table. So 10%, 5 years, going to be these figures here. So 0.909, 826, 751, 683, 621. So 0.909, 0.826, 0.751, 0.683, and 0.621. So 10% discount rates. When we discount all of the figures here, the 20,000 remains the same, obviously, because it's not discounted, paid at the start. You've then got 4980. You've got 6936, 8812, 1537, or sorry, 1535 actually, and then 576. Okay, so when we add those across, we get our final NPV, and the final NPV is 2839. And remember, we've dropped the thousands so far, but that would be 2.839 million. Okay, so look, that's no different from really any other NPV that we've looked at up to this point. I suppose what we've got to mention here, because it does say to talk about the risk in the variable cost. So it does say comment on the risk related to the variable cost. So comment on this will be, first of all, the NPV is positive and should be accepted on financial grounds. You would also say there is a risk that the variable cost would be more than 12 that we've used in our analysis. However, if you look at it, there's not a big risk, because looking at the calculation, whereas our expected value, so here's our variable cost, 12 is actually used in here, so we have 12 here, so we can tell that there's only a 20% risk that it's going to be above that, so it's most likely to be 12 or under. So it's not a great risk, so we'll probably say that. So however, there is let's say an 80% risk it will be 12 or less, but further analysis should be carried out. Okay, so it's positive NPV. We should accept it on that basis. There is a risk that the variable cost could be above 12, but it's only a 20% risk, so we're not too concerned, but we probably should do a further analysis to see what would happen if the variable cost was the higher amount of 14.7. But that will pick you up all of the marks available in this particular section.